Hello everyone. I would like to present my joint work with Farooq Javed from Örebro University about dynamics relationship between stock and bond market through a GAS-MIDAS copulus approach. So the motivation of research is that stock and bond are two most important assets for risk management and also for portfolio allocation. Why a stock is considered as a risky asset, a government bond is often considered as a hedge during recession and crisis. So the relationship between stock and bond are weak through time. However, their conditional correlation is time range. That the sign of the correlation changed from positive to negative during 2000. On the other side, the relationship between consumption and inflation also switched the sign from negative to positive during that time. This coincidence does not happen by chance but can be explained by macroeconomics models. So to understand the stock and bond correlation not only help the investor but also serve as a warning signal for the economics where there is change in the condition of the economy. So in this research, we want to propose a GAS-MIDAS copulus models. The idea of the GAS-MIDAS copulus is that it will decompose the dynamics dependent of stock and bond into long-term dependence and the short-term dependence. Where the short-term dependence follow a gas process, the long-term dependence will be explained by other macroeconomic factors. So we can incorporate the knowledge of the current economic condition into the prediction of the stock and bond dependence. And we find that there are a lot of economic variables that can be used to explain the long-term dependence of stock return and bond returns, such as inflation and interest rate, the state of economies, illiquidity, etc. We also incorporate the information from the survey of professional forecaster to have a forward-looking of the business condition to explain the change of this dependence. So in order to models for the dynamics dependence between stock and bond, we will propose a copulus models to capture for this dynamic dependence. The copulus can be very helpful because it can allow us to decompose the joint density into marginal density and a copulus function. So we can choose and operate models for each marginal density and then use a copulus function for capturing these joint dependence. And in this research, we test also with different families of copulus such as Gaussian, students, Clayton, Gumbel, Frank, and also Joe. And we find that the dependence of stock and bond has extreme event, and the student copulus is appropriate. For the next step, we will fix the copulus to be a fixed form function, but we let the parameter to be time varying so we can capture the dynamics dependence. And the GAS-MIDAS copulus models is built based on the gas process. So as you can see here, we have the dynamic parameter is theta and is mapped through a lambda function to a real-life process lambda t, where this lambda t process can be decomposed into long-term dependence and short-term dependence. In this part of short-term dependence, we will see that it depends on the score function. So that is calculated at the gas process, while the long-term dependence, lambda tau here, is nothing but it's just a linear regression of other macroeconomic variable x that could be used to explain for this long-term dependence. So because we have a lot of lax observation of economic variables in the previous time, we also use a weighting function called a MIDAS weighting scheme to regularize the effect of others information. So we could consider that the more recent observation of the economics variables could carry more impact to the change in the dependence. So this weighting scheme can make it easier to regularize for that effect. We also control for the asymmetric effect of the best new shock to stock and bond. For example, the shock, negative shock to stock return will increase or decrease the dynamics dependence more than the positive stock. So for the next step, I will go to the empirical illustration. We would want to model the dependence between stock return and bond returns from 1990s up to the first quarters of 2021. As you will see that the correlation or this is the rolling windows of the realized correlation was positive at the beginnings and then turned out to be negative in 2000s. And in each crisis and recession periods after 2000, the correlation was positive at the beginning and then become increasing to zero levels after the crisis. And in order to explain for this stock bond dependence, we calculate a lot of different macroeconomic variables such that inflation, term spread, and short-term interest rates. We would group these two variables and calculate the principal components of this group, and we call that principal components of inflation and interest rates. We also calculate industrial production, the ADS index for the current business condition, and the cohesion index for unemployment and salary, and then we group these three variables into the PCA state of the economies. And we also have the BXO, the realized volatility of stock and bond, as the PC uncertainty. And we also have the stock illiquidity and bond illiquidity, and then it comes to the PC illiquidities. So in comparison to realized correlation, the PCE inflation and interest rate and the PCE state of economies will move into the same direction, which means that in a good state of economies, the stock and bond will have a stronger positive or correlation or dependence, where in the periods of uncertainties and illiquidities, these stock and bond will move into opposite direction due to the flight to quality phenomenon. So in the copula's context, we will see that all the variables can explain the dependence of stock and bond quite well. For example, if we consider on the effects of the dentals, the effects of the macroeconomics factors to the joint dependence, we will see that a lot of variables turn out to be significant. For example, the PC of inflation and interest rate, the PC of state of the economy, and also the PC of illiquidities. And the survey of professional forecaster also provide very useful information to forecast for the long-term dependence. And we see that in terms of AIC and BIC, the realized correlation turn out to be the best models. However, other competitive models such that the PC inflation and interest rate, the PC of illiquidities, and also the PC of survey professional forecaster also provide very good information. So here is the figures for the long-term components. We will see that the blue dashed line here is created by the GAS realized correlation as the benchmark, and if others variables can come close to this dashed blue line, it should be better. So we see that the combination of the PC inflation and interest rate and illiquidities trace very closely to this long-term change, and we can conclude that inflation, interest rate, and illiquidities are two most important factors to govern for this long-term change dependence. In terms of the total dependence, we will see that all of the lines are very close to each other, and the GAS-MIDAS copulas really become very effective to capture for this dependence. So thank you for listening. See you next time.